Welcome to the ACA conference in downtown Manhattan. I'm Jane King. With me is Josh Duitz, the head of global income and infrastructure at Aberdeen. So great to have you here. And let's just give me an overview of what your job description is.
Great, Jane. It's nice to be here, so thank you for having me. So I manage two distinct strategies. One, a global income strategy where we invest in companies that are growing their dividends over the long term. Okay. And we have a nice dividend yield. If you look at history, companies that grow their earnings and then grow their dividends outperform companies that don't pay dividends, as well as companies obviously that cut their dividends or have no growth in their dividends. So we have a unique strategy where we use something called dividend capture, which allows us to invest in companies across a dividend spectrum. So companies that pay lower dividends as well as higher dividends in order to achieve a good total return for shareholders over the long term. Mm-hmm. So that's the income side of it. I also manage an infrastructure strategy. The symbol is ASGI. I should have said on the income it's AOD and AGD. So on the infrastructure strategy, ASGI, we invest in companies that are infrastructure companies that both on both the public and private side. Okay. And it's a really unique strategy, and that's what we like about the closed-end fund structure, is the fact that you can invest in private companies. So up to 25% of the fund can be invested in private infrastructure companies. And there's several reasons we like infrastructure. So if you look at every several years, American Society of Civil Engineers rates our infrastructure, and the last grade was a C-. And we know why. We see bridges collapse, we see the potholes when we drive. We need to spend more and more on the infrastructure. And emerging markets are building the infrastructure for the first time, and that's a lot because of population growth. Over the past 50 years, the number of people living in the world has doubled, and the number of people living in cities have tripled over that time period. And the population is expected to grow another 25% out to 2050. Most of that population growth, if not all, are happening in emerging markets and developed markets. That makes up about 25% of our fund. I know EM scares a lot of people, but just as an aside, we've been managing an open-end fund, AIFRX, for 15 years, and we're the number one fund over the past 15 years, even with our over allocation to emerging markets, because all those people are all going to need sewers, they're all going to need roads, they're all going to need utilities, they're all going to need cell towers. So we think there's a lot of tailwinds for infrastructure over both the short term and really the long term.
Yeah. And globally too. I mean, it feels like the whole world needs an infrastructure improvement.
Oh, for sure, for sure. And we're seeing that governments during COVID, right? What did they do? They stimulated their economies by infrastructure, by using infrastructure investments. Why? Because in the short term, it stimulates economy, and the long term facilitates growth. Yeah. So we have seen
Makes sense. Yeah. So let's talk about the IRA that was passed by Congress, I don't know, 2 years ago, 1 year ago?
Around a year ago.
How will that impact what you do?
So the IRA, the Inflation Reduction Act, let's just be clear. I don't believe it had anything to do with reducing inflation. Nothing to do with inflation. Probably increasing inflation, right. Not reducing inflation. But it had everything to do with climate change, right? And energy transition. It was the largest investment we ever made here in the United States. In Europe, they're making a similar investment in the energy transition. If you look at it, we're spending money already on it, even before this. So this year, the first half of the year, we spent about $358 billion on the energy transition, the largest amount ever. Last year, wind made up about 10.2% of our energy mix, which was up 100 basis points, solar about 4.8%, up about 80 basis points. So we're already spending on it, and we're seeing that. Now, we won't invest in anything just because of climate change. That's a benefit of what we invest in. It has to have a good total return. And if you look going forward, in order to reach the net zero targets, we need to increase our spending globally on energy infrastructure from about $2 to $4.5 trillion. And that's on the low end of estimates, which is about 4.5% of global GDP. So we think there's great opportunities to invest in the energy infrastructure, and governments are helping out. But even on the private side, it's taken hold because the cost of wind and solar has come down so dramatically over the past decade.
No, there has been, because they haven't been good stocks this year.
They have not.
There's been, the interest rates I know had an issue. Some of these projects were more expensive than what they had planned on. So do you think this is still a long-term story and we're just in a little bit of a retraction?
It's a great point. Like the stocks did very well prior to this and partly because of the IRA. And this year, as you mentioned, those are the reasons: higher interest rates, supply chain issues they've had. But I think what investors are missing out On the other side of it, the revenue side, the power purchase agreements, because of higher inflation, the revenue these companies are going to achieve should be higher than originally thought. So there's certain companies who have misallocated their capital. Thankfully, we've avoided a few of them. But we think that's what investors are missing out. So we do believe in this as a good long-term story, and this is a bit of a hiccup of it. Our fund is about 10 to 15% invested in the energy transition. So we think there's a great opportunity, and even more so right now.
Yeah, I mean, it could be an awesome buying opportunity with what we've seen.
Right.
So this year.
We think so, for sure.
Another big infrastructure is 4G to 5G. So where are we with that in the U.S.?
So that's a decade-long spend. We don't think it's going to happen till the end of the decade to be fully complete. And if we could go back several years, I think I'm certainly old enough to remember when we were all using just our landline phones, and then we started using cell phones, and then our first smartphone, what was it? It was a BlackBerry.
Yeah.
All we did is send emails on our BlackBerries, right? We couldn't imagine the way we would be using our smartphones today, whether it's, Zoom calls like the Jetsons, right? When we're all face to face with each other. We use it, it's our computer in our hand. And that only developed the apps are developed once 4G. Now we haven't had those 5G apps that we've talked about, whether it's autonomous driving cars or remote surgeries. And once that happens, we think the spend will be even greater. If you look back from that transition to 3G to 4G, it's about 30 billion per year, and there's some ebbs and flows. I think we're in an ebb of that, and the spending will get greater. Now, if you want that infrastructure, one other point, the data's gone up 62x since 2011, 62 times. And that's going to accelerate with 5G as well, as we have more uses to it. Now, what's the best way to invest in that? In the infrastructure side, it's investing in the mobile towers, right? The mobile towers are the cheapest way to deploy that spectrum. So that's where we want to invest in. And we think there's great opportunities here in the US as well as outside in the US. Here in the US, the companies generally get to increase their prices about 3% per year, which was great prior when inflation was so low last year or so. You're like that lag behind. But the companies that we invest in both in Europe as well as in emerging markets, many of those companies get to raise their rates with inflation every year. So there's an inflation protection component to it. That's why we like infrastructure a lot. We've talked about this for 15 years, inflation protection component. Last year was the first time we really had inflation. Infrastructure stocks really outperformed. Now, I don't think inflation has come down, but we haven't come down to the levels of zero inflation. We're still 3+% inflation, and we think that's a great bet to hedge that inflation by investing in infrastructure companies.
Well, and interesting you pick the towers too, because they will benefit no matter who has the Internet of Things or
Correct.
Web3 or whatever. So you're really kind of, I guess covering your bases with the towers.
Right. And that's what we love about infrastructure, because it's really a defensive sector as well. If you go back to the GFC and you look at globally listed infrastructure companies, the EBITDA grew even during the GFC. So we're really investing in these essential assets that every society needs to function and to grow their economies. So there's a defensiveness to it, plus an inflation protection to part of it. Plus they have these sustainable, predictable cash flows, which allow them to pay dividends, and there's a nice yield to go along with it.
Okay, so we're heading toward the end of the year. What are you thinking about for 2024? What's kind of on your radar screen?
So there's always a lot going on. And I want to make the point, especially for the income fund, we try not to take major macro bets, right? Because if we were having this discussion last year at this time, everyone was talking about a hard landing, right?
A recession for sure.
Hard landing did not come, and now we're talking about a soft landing or possibly a Goldilocks landing. And we think we're much better by investing, being fundamental bottom-up stock pickers, and that's what we really try to do, rather than trying to take macro bets for the future. It doesn't mean we're not aware of the macro. We'd be remiss if we ignored the macro. So when we talk about the macro, I'm not trying to predict the macro, we're aware of the macro. So what does that mean for us? What it means is that interest rates are higher, probably higher for longer, as we talked about. So how does that affect the companies that we invest in, right? This year, there's not many companies that have the floating rate debt, but if you had fixed rate debt, the refinancing is starting to come next year, the year after, and we want to understand the effects that the refinancing will have on the company's income statement. Like, Because we were just looking at a company that was paying 1.5% to 3% interest rates at $1 billion due each for the next 2 years. So I'm assuming they're going to have to pay 400 to 500 basis points more on that debt that's coming due. Are they going to be able to refinance it, or that's going to be a $40 to $50 million hit to their earnings? So those are the type of things that we're focusing on, and the companies, and making sure we're comfortable with their balance sheet, that they could still grow those dividends and pay those dividends.
Okay, very interesting, Josh. Thank you so much.
Great, thanks for having me, Jane.
Thanks.